The greatest show on earth is not on a stage, but in the global marketplace. It is a spectacle of risk, reward, and deeply human irrationality. We chase fortunes with algorithms and spreadsheets, believing in pure logic. Yet, beneath every stock ticker and investment decision lies an ancient wiring. The human mind is the most volatile factor in any financial equation. It's a truth few professionals dare to acknowledge openly. The system is built on mathematical certainty, but we operate on emotion. This disconnect is the core mystery of modern wealth. Why do some people with modest incomes accumulate vast sums? Conversely, why do lottery winners and high-earning executives so often end up broke? The answer is rarely found in their education or their income level. It resides in their unseen, often unconscious, psychology of money. The rules of finance are simple, the rules of human behavior are complex. We inherit biases from our parents, our generation, and the economy we grew up in. Our personal history with money dictates our future spending and saving habits. This script is an investigation into the psychological traps that keep the majority poor. It is about the dangerous allure of getting rich quick. It's about the fear of missing out, or FOMO, that drives bubble markets. We will peel back the layers of societal myths surrounding success. The documentary will expose the fundamental flaw in how we are taught to think about money. It's not just about what you know, but how you behave when the pressure is on. The financial world often rewards patience, humility, and long-term thinking. These are traits that run counter to our immediate, impulsive nature. We are programmed for instant gratification, a design flaw in the age of compounding returns. The gap between financial literacy and financial success is a chasm. This chasm is paved with human error, pride, and the inability to simply stop. We look for complex solutions to problems that are fundamentally simple. The poor mindset is less about the size of the bank account and more about the structure of the mind. The journey begins by accepting that money is a feeling before it is a fact. Our exploration begins by establishing the battlefield, the financial mind. We introduce 3 key archetypes whose stories illustrate core psychological flaws. First, there is the high roller, a successful but volatile entrepreneur. He possesses immense talent but suffers from an over-reliance on confidence. His early success blinds him to the concept of statistical risk. He believes his past victories guarantee future ones, an illusion of control. His story will show the peril of survivorship bias in personal finance. Next, we meet the stagnant saver, a person of modest income who saves religiously. She is risk-averse to an extreme, paralyzed by the fear of losing what she has. Her fear prevents her from investing, causing her savings to be slowly eroded by inflation. She embodies the psychological cost of missed opportunity, the hidden tax on safety. Her fear is rational on the surface, but financially destructive in the long run. Finally, there is the social climber, living paycheck to paycheck on a 6-figure salary. His entire financial life is a performance for an external audience. He buys expensive cars and houses not for utility, but for status signaling. He perfectly illustrates the trap of spending to keep up with the Joneses. His inability to define enough is his ultimate financial downfall. These 3 individuals represent the spectrum of psychological issues with money. Their stories are interwoven with expert commentary from behavioral economists. These experts explain the deep-rooted cognitive biases at play. We examine the concept of recency bias, where recent events disproportionately influence decisions. The crash of 2008 still haunts the stagnant saver, making her fear a new collapse. The bull market of the 2020s fuels the high roller's reckless confidence. The stage is set in modern global cities, glittering symbols of wealth and inequality. We show the contrast between the appearance of wealth and the reality of net worth. The true subject of our script is not the money itself, but the human operating system. We are attempting to debug the faulty software that consistently undermines prosperity. The goal is to shift the focus from the mechanics of the market to the mechanics of the mind. The central enigma is simple: why is good financial advice so often ignored? The best practices for building wealth are not secret, they are widely published. Save consistently, invest broadly, be patient, and avoid unnecessary debt. Yet, the vast majority of people fail to execute these simple steps. The initial problem is the failure of logic to conquer emotion. We frame this as a behavior gap, the distance between what we know and what we do. The human mind is a time-traveling machine, but we struggle with future self-thinking. When we make a spending decision today, the future cost feels abstract. This is called hyperbolic discounting, valuing immediate pleasure over future gain. We interview a certified financial planner who sees this struggle every day. She describes clients who understand compounding interest perfectly. However, they still pull their money out of the market during a minor dip. This panic is not a flaw in their intelligence, but a flaw in their stress response. The mystery deepens when we examine the concept of financial tribalism. People take on debt to conform to the spending patterns of their immediate social group. A $50,000 car seems mandatory if everyone else in the office drives one. This desire for social acceptance overrides sound financial planning. The mystery is compounded by what we call the lottery paradox. Millions play the lottery, a statistically terrible investment, driven by a sliver of hope. They ignore the 401k, a statistically guaranteed pathway to wealth. The brain is more captivated by the narrative of a sudden, huge win. It dismisses the boring, steady, incremental process of compounding. The poor mindset is therefore a failure of imagination regarding the long term. It cannot emotionally connect with the person they will be in 20 years. The mystery is why this basic psychological fault line persists across all income levels. We realize the true problem is not the absence of a formula, but the presence of bias. It's a universal and deeply ingrained bug in the human condition. This initial problem sets our investigative trajectory toward the subconscious. The first major clue lies in the concept of historical context and luck. We discover that every person's financial worldview is a product of when and where they were born. A person who grew up during the 1970s, high inflation will forever fear cash sitting still. Someone who started investing in the dot-com boom will be biased toward tech stocks. This is not rational analysis, it is deeply personal, lived experience. The crucial discovery is that rational financial decisions are impossible without acknowledging this bias. We introduce an economist who studies the impact of recessions on future behavior. He shows data proving that people who experienced a major economic crash young save more. They take less risk, regardless of how safe or diversified the current market is. Their financial decisions are an emotional reaction to a past trauma. This is the scarring effect on the financial psyche. We revisit the high roller and find his reckless confidence is tied to a privileged childhood. His family always bailed him out, creating an emotional safety net against risk. He views the market as a game he can always restart, not an existential threat. The stagnant saver's paralysis, conversely, is tied to her parents losing everything. For her, the stock market is not a path to growth, but a casino that will eventually bankrupt her. The clue is that the good decision is relative, not universal. What feels rational to one person is terrifying to another based on their invisible history. We must treat financial advice not as a universal law, but as a personalized therapeutic intervention. The key discovery is that there is no single right way to handle money. There are only ways that are compatible with your psychological wiring. We must look beyond the spreadsheet and into the individual's autobiography. The financial world pretends to be objective, but it is intensely subjective. The secret to success is finding a plan you can stick with when everything is on fire. That sticking power comes not from math, but from emotional resilience. The first step to escaping the poor mindset is an excavation of your personal financial past. The origin of the poor mindset is traced back to two fundamental human needs. The first is the need for control, the second is the need for status. We delve into the evolutionary psychology of money. Historically, status signaled safety, access to resources, and reproductive success. Money has simply replaced the size of the herd or the success of the hunt. The social climber's expensive possessions are a primal display of fitness. He is not buying a luxury good, he is buying the perception of a higher rank. This context explains why people will take out predatory loans for designer goods. The immediate dopamine hit of status outweighs the long-term pain of debt. We examine the concept of lifestyle creep, the quiet killer of wealth. As income rises, so does the baseline standard of living, erasing all gains. This creep is driven by our inability to internalize a new, higher income. We quickly normalize the new level of spending as the minimum required. The origin is a hedonic treadmill that money cannot stop. The context of modern finance complicates this primal wiring. The rise of social media turns this status competition into a global, 24/7 spectacle. The Joneses are no longer the neighbors, they are perfectly curated influencers. This constant comparison ratchets up the psychological pressure to spend. We introduce the key concept of the man in the car paradox. When you see a person driving a beautiful Ferrari, you don't think about the driver. You imagine how you would look and feel driving that car. The driver thought the car would earn him admiration, but the admiration is for the object. The paradox is that people want wealth to be respected, but they spend their wealth to get it. This spending ensures they never truly accumulate the lasting wealth they desire. The deep-seated context is a cultural script that equates spending with happiness. The poor mindset is simply the result of following this script to the letter. The antidote is a radical redefinition of success that is internal, not external. It requires separating one's self-worth from one's net worth. This separation is the foundational step in building a rich psychological framework. The financial world is split between two conflicting theories of success. Theory A: the market is rational, efficient market hypothesis. This theory posits that all public information is priced into the stock market. Therefore, individual efforts to beat the market are futile, success is purely mechanical. Theory B: the mind is the ultimate variable, behavioral economics. This theory argues that the market is a collection of emotional, irrational actors. Success is not about knowing what a stock is worth, but knowing how other people will feel about it. The stakes escalate as we see how these two theories play out in real time. We show a split-screen montage of a financial crisis, perhaps the 2008 collapse or a major market drop. The rationalists, Theory A, see a technical correction and a buying opportunity. They trust the historical data and calmly execute their pre-planned strategy. The emotionalists, Theory B, see a cascading failure and a reason to panic. Their amygdala, the brain's fear center, overrides their prefrontal cortex, the logic center. The stakes are the billions of dollars lost by individuals during moments of panic selling. This is the ultimate cost of the poor mindset, selling low when the smart money is buying. We introduce the concept of path dependence in financial decision-making. A small emotional mistake early on can lead to catastrophic results later. A student loan taken out for a non-essential degree becomes a lifelong anchor. A decision to pull $10,000 out of the market early means missing decades of compounding. The conflicting theories force us to choose a framework for action. We argue that while Theory A explains the market, Theory B explains the investor. True financial wisdom lies in using rational tools, Theory A, with emotional self-awareness, Theory B. The greatest danger is not market volatility, but personal volatility. The poor mindset treats every market dip as an unmanageable crisis. The rich mindset treats every dip as a temporary, statistical event to be exploited. The escalating stakes are the time horizon, the years and decades of potential lost wealth. We must confront the emotional narratives that force us to deviate from the rational plan. The battle is not against the market, the battle is within the self. The point of no return is reached when an individual's financial story becomes fixed. This story is the narrative they tell themselves about money and their place in the world. For the high roller, the point is reached when his hubris becomes indistinguishable from his strategy. He bets everything on a single, highly speculative venture, convinced of his genius. His belief in his own exceptionalism has become a form of blindness. The poor mindset believes that extraordinary results require extraordinary, high-risk actions. They discount the boring effectiveness of merely being consistently good. For the stagnant saver, the point is reached when her fear manifests as total withdrawal. She pulls her money from the bank, stuffing it into a safe or under the mattress. Her story is one of complete distrust in all financial institutions and the future itself. She has traded the small risk of market loss for the guaranteed loss of purchasing power. Her point of no return is the surrender of hope for future growth. For the social climber, the point is the purchase of the status house or the status car. The debt load is so immense that it requires constant, high-stress, high-income work. He is now running just to stay in place, enslaved by his consumption. He has permanently outsourced his definition of success to his creditors and his peers. The collective point of no return for the poor mindset is the loss of financial independence. This is the moment when income is no longer a tool for freedom, but a required payment for past choices. We show the stark difference between wealth and income. Income is what you earn, wealth is what you keep and what it earns for you. Many high-income earners are functionally poor because they reach this point of no return. Their consumption requires them to keep working, eliminating the possibility of choice. The rich mindset defines freedom as the ability to stop working if they choose. The point of no return is psychological long before it is mathematical. It's the moment when the mind accepts the false premise that more spending equals more happiness. Breaking this narrative requires a dramatic, internal intervention. It is the realization that true wealth is invisible, boring, and fundamentally unshowable. The midpoint twist shatters the common belief that wealth is built on optimism. The halfway revelation is that sustainable financial success is actually built on pessimism. Not paralyzing, fear-based pessimism, but realistic, sober assessment of risk. The truly wealthy are not eternal optimists about the market's smooth ascent. They are pragmatists who plan for failure, for collapse, and for black swan events. Their financial plan is a disaster preparedness manual, not a growth forecast. This is the core difference between the high roller's foolish confidence and true resilience. The high roller never planned for a market downturn, only for a triumphant victory. When the inevitable downturn comes, he is wiped out because he never built a margin of safety. We introduce the concept of room for error as the most important financial metric. It is the one lesson that separates the enduringly wealthy from the temporarily successful. Room for error is having enough cash reserves to sleep well during a crisis. It is building a portfolio diversified enough that a single stock's collapse won't matter. It is having a low enough debt payment that a temporary job loss won't trigger bankruptcy. The twist is that the goal of money is not to earn the highest return, but to survive long enough. Survival is the hidden superpower of compounding interest. If you survive market volatility, time will work its magic, regardless of a genius strategy. The poor mindset seeks the highest potential upside, ignoring the catastrophic downside. They treat risk as a hurdle to be cleared, not a perpetual threat to be mitigated. The rich mindset treats risk as a permanent feature of the landscape. They build fences, bunkers, and escape routes into their financial architecture. The revelation is that true wealth is defined by what you don't have to risk. The richest people often make the most boring, conservative financial decisions. They understand that the game is played over decades, not quarters. The twist is the substitution of a flashy, optimistic narrative with a sober, defensive one. Financial peace comes from having a plan that accounts for everything going wrong. The truth, that the poor mindset is a behavioral issue, not an intellectual one, is often suppressed. The financial industry has a vested interest in promoting complexity and genius. Complexity justifies high fees for active fund managers and expensive financial advisors. They sell the narrative of secret knowledge and algorithmic superiority. This suppresses the simple truth: low-cost, passive index funds outperform most experts over time. The industry profits from the poor mindset's belief in a quick fix or a genius guru. We show examples of financial news programs that constantly focus on short-term market noise. This sensationalism feeds the high roller's addiction to action and the stagnant saver's fear. It suppresses the boring truth: long-term wealth is built on inaction and patience. The media's focus on the daily fluctuation obscures the power of the long-term trend. Governments and politicians also inadvertently suppress the truth. They often focus on complex tax codes and economic theories to solve inequality. While important, this focus distracts from the core behavioral problem of personal finance. The truth that saving a small amount, consistently, is a powerful social solution is ignored. The poor mindset is encouraged by a culture that prioritizes immediate consumption over future stability. Debt is normalized, and saving is often portrayed as a sacrifice, not a pathway to freedom. The attempt to suppress the truth is the constant search for the external cause of poverty. We look for flaws in the system, the economy, or the institutions. While systemic issues exist, the personal behavioral flaws are often overlooked. The poor mindset is therefore a convenient narrative for a complex system. It allows the individual to avoid accountability for their own choices and habits. The suppression is a collective psychological defense mechanism against simplicity. The simple truth is the hardest to accept because it requires personal change. The antidote is to aggressively ignore the noise and embrace the boring efficiency of consistency. The pursuit shifts to confronting the core emotion that drives the poor mindset: envy. Envy is the feeling of distress at the superiority of another person's possessions or situation. It is the engine that drives the social climber's self-destructive spending. We confront the idea that envy is the most financially dangerous emotion. It forces us into a comparison that is always biased and incomplete. We only see the person's luxury car, not the crushing debt payments. We only see the perfect vacation photo, not the anxiety of the credit card bill. The confrontation is internal, recognizing when your financial decisions are driven by envy. The poor mindset uses money as a scorekeeping mechanism against others. The pursuit of true financial peace requires a confrontation with the relativity trap. We are not satisfied by absolute wealth, but by relative wealth compared to our peers. This is a game we can never win, as the peer group is constantly being updated and expanded. We show the stories of people who intentionally downsized their lives and social circles. They confronted their need for external validation and found peace in financial independence. Their confrontation was the realization that their money was being used to buy someone else's approval. The rich mindset understands that money's highest value is its ability to buy time and options. It is the quiet confidence of having enough to walk away from a bad job or a bad investment. The pursuit is therefore a quest for emotional sovereignty over one's finances. It requires the difficult act of defining what enough means for you, personally. Enough is a foreign concept to the poor mindset, which always seeks more. More is always relative to what someone else has, making the target unreachable. The confrontation involves accepting that you don't need the maximum return. You only need a return that is sufficient for your defined, personal goals. The pursuit of wealth must be a solitary and deeply philosophical journey. The final pieces of the puzzle revolve around time, compounding, and patience. We illustrate the power of compounding with a simple, stark visual comparison. Investor A saves $10,000 a year for 10 years and then stops, total invested $100,000. Investor B waits 10 years, then saves $10,000 a year for the next 30 years, total invested $300,000. Despite investing 3 times more, Investor A, who started early, often has more money. The piece that falls into place is that time is the most valuable asset in finance. The poor mindset consistently undervalues time and overvalues a sudden influx of cash. They seek the spectacular, high-return investment that ignores the power of duration. The concept of getting rich slowly is the central, unglamorous truth. Patience is the only ingredient in the financial formula that is purely psychological. The high roller fails because he won't wait for compounding to work, he tries to force it. The stagnant saver fails because she is too afraid to give compounding the opportunity. The social climber fails because his spending constantly interrupts the compounding process. The final piece is the realization that money is a tool to manage emotions, not a solution to them. A pile of cash won't fix a mind that is constantly anxious, envious, or overconfident. Wealth is simply the scoreboard of a successful application of simple behavioral principles. The entire script comes down to a few core psychological virtues. Humility to accept that you don't know everything and that luck plays a role. Patience to let the math do the work, even when the market is terrifying. The ability to define enough to stop the hedonic treadmill of consumption. These are not financial skills, they are life skills applied to money. When these pieces fall into place, the poor mindset dissolves. It is replaced by a serene confidence that comes from a plan you can endure. The primary conclusion is that the single greatest determinant of financial success is not intelligence, education, or even income, but temperament and behavior. The truth revealed is the radical simplicity of financial prosperity. The poor mindset is not a result of a lack of knowledge, but a defect in emotional control. It is the inability to distinguish between what you can do and what you should do. The high roller could take a massive risk, but the wealthy person should not. The stagnant saver could invest, but her fear dictates inaction. The core of the poor mindset is a fundamental misunderstanding of probability. People treat unlikely events, a crash tomorrow, as certainties. They treat certain events, long-term compounding, as unlikely long shots. The wealthy temperament is one that masters 2 key emotional concepts. The first is the recognition of luck, understanding that not all success is skill. This humility prevents overconfidence and the recklessness that follows. The second is the mastery of fear, viewing volatility as a cost of admission, not a rejection. This allows them to remain invested when others are fleeing the market. The ultimate truth is that wealth is an invisible score, earned not by transactions but by abstinence. It is the car you chose not to buy, the vacation you chose not to take, and the stock you chose not to sell. It is the value of those choices compounding quietly over decades. The only competition that matters is between your current self and your future self. The poor mindset is characterized by the short-term self consistently sabotaging the long-term self. The rich mindset is the practice of consistently serving the interests of your future self. The ultimate lesson is that money is a mirror reflecting who you are. Your financial health is a direct readout of your emotional health. Change your mind, and your money will follow. The aftermath of this realization reshapes the lives of our three archetypes. The high roller, having lost his fortune, gains the humility he lacked. He rebuilds slowly, prioritizing the margin of safety over the maximum return. His legacy becomes one of resilience and the sober recognition of risk. The stagnant saver confronts her fear, realizing her inaction was the greater risk. She begins a dollar-cost averaging plan, automating her investment to bypass her emotions. Her legacy is one of overcoming financial trauma through disciplined action. The social climber sells the status symbols that were enslaving him. He redefines his life around his internal values, finding peace in his lower burn rate. His modern tie is to the growing movement of financial independence, retire early, FIRE. This movement is a rejection of the consumerist, poor mindset. It is a philosophy that prioritizes the freedom of time over the display of wealth. The legacy of this psychological shift is a healthier, less anxious society. We tie this back to the modern challenges of income inequality and student debt. While systemic solutions are needed, a pervasive rich psychological mindset is a powerful defense. It is the personal armor against a world constantly encouraging overspending. The modern ties are everywhere, in the gamification of stock trading that encourages high-risk behavior. It is in the constant stream of advertising that feeds the need for status. The poor mindset is perpetually being reinforced by the surrounding environment. The solution is not to become a genius investor, but to become an emotionally stable one. The real power of money is its ability to give you control over your own time. This control is the ultimate luxury and the truest measure of wealth. The aftermath of this truth is a quieter, less spectacular, but infinitely more secure life. The journey concludes with a summary of the essential rules of financial psychology. Define enough. The poor mindset never stops, the rich mindset knows its finish line. Room for error, always plan for the worst, survival is the key to long-term success. Time over timing, the greatest gains come from duration, not from market prognostication. Invisible wealth, true prosperity is quiet and unshowable, it is what you keep. Be humble, accept the role of luck, it guards against self-destructive overconfidence. Price of admission, view volatility and fear as the necessary cost of long-term growth. The poor mindset is not a curse of low income, it is the habit of making emotional mistakes with money. It is the constant, self-inflicted sabotage of the future self. The rich mindset is the consistent application of boring, sustainable, and emotionally sound principles. It is the long, quiet walk to freedom, not the sprint to instant riches. The true mystery that still lingers is why this simple truth remains so difficult to implement. Why do we, as intelligent, rational beings, continue to fall for the same emotional traps? The answer lies in the persistent, primal conflict between our ancient wiring and the modern world. We are designed for scarcity and immediate reward, but we live in an age of abundance and delay. The poor mindset is, in a way, the natural human default. The rich mindset is an unnatural act, a conscious, disciplined override of our emotional instincts. The final frame shows a person calmly watching a volatile stock ticker, not panicking. This serenity is the ultimate wealth, a psychological victory that transcends market fluctuations. The path to financial freedom is a path of self-mastery. The script ends with a final, powerful thought: the best financial tool you possess is your own mindset.